Money's greatest value isn't in acquiring luxury items, but in the power it gives you to control your time and life, the true essence of freedom. The Psychology of Money by Morgan Housel is a must-read for anyone determined to make smarter financial decisions and form a healthier relationship with money. The book dives into the psychology of our money habits. Housel argues that the key to mastering your financial life and achieving happiness boils down to two crucial steps. 1. Define your financial goals with crystal clarity. 2. Craft a personalized plan to achieve them and stick to it. Forget about impressing others, because it's ultimately meaningless. Here's some great news. Mastering money isn't about IQ, math skills, or technical knowledge. It's about behavior. We're all hardwired with unique tendencies, shaped by our passions, fears, and dreams. When we think about money, we all have distinct reactions, thoughts, and emotions that are deeply personal. Understanding the psychology of money means becoming aware of these tendencies. Once you realize your emotional and psychological patterns, you can harness your mind and willpower to transform your financial life. Even though finance is often taught as a technical, math-driven field where formulas guide decision-making, the reality is that humans are irrational, emotional creatures, not cold, calculating machines. Most finance books dive into technicalities like stock selection or portfolio optimization. But the truth is, financial success relies more on mastering emotional intelligence and managing impulses than on understanding charts or market laws. Consider this: over time, we've perfected skills like farming, plumbing, and chemistry through trial and error. But when it comes to personal finances, how much have we really improved? Are we less likely to fall into debt? Do we save more for emergencies or retirement? The author argues, and I agree, that there's little evidence we're any better at managing money today than we were decades or even centuries ago. And that's actually a good thing. You don't need an MBA in finance or a background in financial engineering to build wealth. Patience and a healthier relationship with money are the real keys. The Psychology of Money is a collection of short stories that explores the odd ways people think about money. Housel highlights biases, flaws, and behaviors that influence financial decisions, showing how our psychology can either propel us forward or sabotage us. With this insight, we can make smarter financial decisions. This summary offers a few actionable lessons that can help improve how we manage money by understanding how our minds work for us or against us. Chapter 1. No one's crazy, everyone has unique perspectives on money. Despite money existing for thousands of years, many of us struggle with saving and planning for retirement. We often make irrational financial decisions, but that doesn't make us crazy. Two key reasons explain why we don't always handle money as we should. 1. We're new to the game. Modern financial tools are surprisingly recent. For example, the USA's 401k retirement plan only came into existence in 1978, and the Roth IRA wasn't introduced until 1998. It's younger than some college students. Even index funds, now a cornerstone of investing, were developed in the 1970s. With less than 50 years to figure these tools out, it's no surprise we're still learning how to play this complex game. 2. We all view money differently. Our relationship with money is shaped by personal experiences. Someone who grew up in poverty sees risk and reward differently from someone raised in wealth. A stockbroker who lost everything in the Great Depression has a completely different perspective than a tech worker who thrived during the late 1990s. An Australian who hasn't seen a recession in 30 years lives in a reality that most Americans can't relate to. We're all operating with unique life experiences that inform how we think about money. What seems irrational to one person may make perfect sense to another, not because one is smarter, but because they've lived different lives. Your personal experience with money represents 0.1% of what's happened in the world, but it makes up 80% of how you think the world works. The key takeaway: making decisions based solely on personal experiences is risky because the world is constantly changing. Instead, align your financial choices with your goals and the tools available today, not with outdated lessons from the past. Chapter 2. Luck and risk bigger than skill. Nothing is as good or as bad as it seems. Success isn't always about hard work, and failure isn't always about laziness. While we like to think outcomes are the result of effort and skill, they are often shaped far more by luck and risk. No financial success or failure is entirely within our control. With 7 billion people and countless moving parts in the world, unintended consequences often outweigh deliberate action. Take the story of Bill Gates. Sure, he was brilliant, hardworking, and had an uncanny connection to computers. But he also got incredibly lucky. He attended one of the few high schools in the world at the time that had a computer 1 in a million chance. Gates eventually co-founded Microsoft with Paul Allen. The friend Kent Evans, equally talented and passionate about computers, wasn't so lucky. He tragically died in a mountaineering accident and high school a 1 in a million risk. Same skills, same passion, but polar opposite outcomes due to forces beyond their control. When we analyze the lives of billionaires or CEOs, it's tempting to say, do what they did to succeed. But the truth is their outcomes often hinge on luck, while those who fail might simply have faced bad risks. Instead of obsessing over individual stories, the author suggests focusing on broader patterns of success and failure. For example, trying to replicate Warren Buffett's legendary investment success is nearly impossible. His results are so extreme that luck likely played a significant role, and luck isn't something you can copy. But noticing that people who have control over their time are generally happier. That's a widespread pattern you can act on. Recognizing the impact of luck and risk makes us more grounded. It encourages humility when life is going well, you're not invincible, and compassion when it's not, you're not a failure. Chapter 3: Never Enough, Know When to Stop. Many wealthy individuals lose everything because they don't know when to say enough. The key lesson here is simple: never risk what you already have a need for something you don't have and don't need. The book highlights the downfalls of Rajat Gupta and Bernie Madoff, two people who had it all but craved even more. Their greed led to their undoing because they couldn't stop moving the goalposts. The hardest financial skill isn't earning or investing, it's knowing when to stop shifting your goals. Achieving one milestone often makes us immediately look toward the next, creating an endless cycle fueled by comparison to others. And guess what? Someone will always have more money than you. That's life, and it's perfectly fine. Having enough doesn't mean giving up on ambition or financial success. It means knowing your limits and avoiding regret. Certain things, your reputation, freedom, relationships, love, and happiness are too valuable to gamble, no matter the potential reward. There's no reason to risk what you have a need for what you don't have and don't need. Chapter 4: Confounding and Compounding, the Secret Ingredient. Good investing isn't about chasing sky-high returns that happen once in a blue moon. Instead, it's about earning decent, repeatable returns over a long period of time. That's when the magic of compounding truly kicks in. Take Warren Buffett, for example. Yes, he's a brilliant investor, but his true secret weapon isn't some fancy strategy, it's time. Buffett started investing at the age of 10. By 30, when most people are just starting to invest, he already had $1 million. But here's the kicker: $81.05 billion of his $84.05 billion net worth came after his 65th birthday. Decades of consistent investing allowed compounding to work its wonders, creating a snowball effect that made his fortune extraordinary. Compounding works like growing oak trees. In the first year, you'll barely see any progress. After 10 years, the growth becomes noticeable. And by 50 years, you've got a towering giant. The key is patience, giving your investments enough time to grow. The mistake many people make is taking huge risks in pursuit of massive returns. But instead of swinging for the fences, aim for stable, consistent growth. Start investing as early as possible and let time do the heavy lifting. Compounding might seem subtle at first, but its long-term power is mind-blowing. $81.05 billion of Warren Buffett's $84.05 billion net worth came after his 65th birthday. Our minds are not built to handle such absurdities. Chapter 5: Getting Wealthy vs. Staying Wealthy, Different Skill Sets for Different Goals. Good investing isn't about making brilliant decisions, it's about consistently avoiding disastrous ones. Earning wealth requires taking risks, staying optimistic, and seizing opportunities. While holding on to that wealth, that's a completely different ball game. It demands humility and fear of recognizing that what you've gained could vanish just as quickly. Frugality and acceptance, understanding that luck played a role in your success, and past wins don't guarantee future victories. The key to financial success is survival. It's not about hitting home runs, it's about staying in the game long enough for compounding to work its magic. A survival-first mindset comes down to these 3 lessons. Prioritize resilience over returns. More than chasing massive gains, focus on being financially unbreakable. If you're unbreakable, you'll stick around long enough to see compounding work its wonders. Plan for plans to fail. A solid plan leaves room for error. It's great to hope for an 8% market return, but a good plan means you'll still be okay even if it's only 4%. Flexibility makes you financially unshakable. Balance optimism and paranoia. Believe that the long-term odds are in your favor, but always prepare for the short-term chaos. Life is messy, and success demands both hope and caution. For perspective, consider the last 170 years in the U.S. economy. During this time, life improved dramatically, our standard of living increased 20-fold. but it wasn't without setbacks. 9 major wars claimed 1.3 million lives. 4 U.S. presidents were assassinated. A flu pandemic killed 675,000 people in a single year. There were 33 recessions lasting a cumulative 48 years. Stocks lost over 10% of their value more than 100 times, and they lost a third of their value at least 12 times. Despite all these challenges, optimism about the future prevailed, proving that resilience, patience, and a long-term perspective are key to thriving financially. Chapter 6 tells you when embrace failures. They're part of the game. You can be wrong half the time and still make a fortune. Warren Buffett has owned between 400 and 500 stocks throughout his life, but the majority of his wealth came from just 10 of them. This highlights the power of long-tails, rare, extreme events that have an outsized impact in business and investing. Most of the decisions you make won't matter much in the grand scheme of things. It's those few pivotal moments like a market crash, a boom, or a bubble that truly shape your financial destiny. The key to successful investing is not about being right every time, but about staying calm and making the right move during those rare, high-impact moments. A true investing genius is someone who can stick to their strategy when everyone else is panicking or getting swept up in the latest trend. Chapter 7: Freedom. Controlling your time is the highest dividend money pays. The greatest form of wealth is the freedom to wake up each day and say, I can do whatever I want, whenever I want, with whoever I want, for as long as I want. Money's true value lies not in material things, but in the power it gives you to control your time. This freedom, more than your salary, the size of your house, or the prestige of your job, is the most rewarding return money can offer. Chapter 8: Man in the Car Paradox. Money doesn't buy respect. No one is impressed with your possessions as much as you are. The man in the car paradox explains that people don't actually think someone is cool just because they drive a fancy car. Instead, they imagine how impressive they'd look if they had that car themselves. This is a paradox. While you may think your car earns you respect, others are simply comparing it to their own desires. The same applies to wealth. People often chase wealth in hopes it will earn admiration, but it only sets a new benchmark for others to measure their own success. If you're seeking respect, remember, humility, kindness, and empathy will earn you far more admiration than any material possession ever will. Chapter 9: Wealth is what you don't see. The difference between rich and wealthy. Spending money to show people how much money you have is the fastest way to have less money. We often judge wealth based on what's visible: big houses, flashy cars, expensive items. However, true wealth is what's hidden. Being rich means having a high income and spending it on visible luxuries, while wealth is accumulated quietly through savings and delayed gratification. Wealth is about choosing to forego immediate spending for future opportunities, flexibility, and growth. The difference between being rich and being wealthy lies in making choices that allow your wealth to grow over time, rather than spending it to impress others. Understanding this difference is key to making smarter financial decisions. Chapter 10: Save money. Your savings rate is key. The only factor you can control generates one of the only things that matters. Wealth building isn't primarily about income or investment returns, it's about your savings rate. You can accumulate wealth without a high income, but you cannot do so without saving a significant portion of what you earn. Saving doesn't require a specific goal or purchase in mind, it simply gives you the freedom to make choices and remain flexible. If you care less about impressing others, you'll find it easier to spend less and save more. Having savings without a goal allows you the freedom to wait for the right opportunities, whether in investments, your career, or personal life. It gives you time to think, change directions, and adapt to new opportunities on your own terms. Chapter 11: Reasonable rational. Being rational is draining. Aiming to be mostly reasonable works better than trying to be coldly rational. Being completely rational about financial decisions can be exhausting and unsustainable. It's more practical to aim for reasonableness, choosing a financial strategy that you can maintain over the long term. Short-term volatility shouldn't force you to make hasty decisions. Historical data shows that positive returns are likely over longer periods: 68% over 1 year, 88% over 10 years, and 100% over 20 years. Rational investors focus solely on numerical facts, while reasonable investors consider the social aspects of decision-making, like how their choices may be perceived by colleagues. An ideal investment strategy is one that balances solid returns with the ability to live comfortably and maintain control over your life. It's a strategy that holds up even during tough economic times, something that purely financial models often overlook. Chapter 12: Surprise. Things that have never happened before happen all the time. History is a study of change, ironically used as a map for the future. History is not a reliable guide to the future of the economy or stock market because it doesn't account for the new, structural changes that shape today's world. While past surprises highlight our inability to predict the future, they also remind us that the most impactful economic events will be unprecedented. These events, whether negative, like recessions and wars, or positive, like innovations, are often things history can't prepare us for. Though history can help set expectations, show common mistakes, and give general insights, it cannot serve as a detailed map for future events. The further back you look, the more general your takeaways should be, such as understanding human behavior, reactions to fear and greed, or responses to incentives. Specific trends, market movements, and financial advice are always evolving and shaped by ongoing changes. Chapter 13. Room for error. Have a margin of safety. The most important part of every plan is planning on your plan not going according to plan. Unforeseen events happen all the time, and it's nearly impossible to prepare for risks that you can't predict. The best way to protect yourself from these unknowns is to avoid relying on single points of failure. A good rule to live by is that anything that can break will eventually break. If multiple things depend on a single factor, and that factor fails, disaster is likely to follow. The most significant financial risk is relying solely on a paycheck to cover your expenses without any savings to buffer potential future costs. When estimating your future returns, it's wise to leave room for error. For example, the author assumes his future investment returns will be about 1/3 lower than the historic average for the S&P 500, 6.8% since 1870, so he saves more than he would if he expected returns to match historical averages. This creates a margin of safety. Saving doesn't always require a specific goal. While saving for a car, house, or retirement is important, it's also crucial to save for unexpected future expenses that you can't predict. Predicting your future expenses assumes a level of certainty no one has. Save as much as you can because the future is unpredictable, and you may need savings for things you can't foresee. Chapter 14. You'll change. Expect your future self to have different goals and desires. Long-term planning is harder than it seems because people's goals and desires change over time. Long-term financial planning is challenging because our goals and desires evolve over time. Humans tend to underestimate how much our personalities and goals would change. This is known as the end of history illusion, a psychological phenomenon where people recognize how much they've changed in the past but fail to predict how much they will change in the future. For instance, we may think we'll never want kids or a big house when we're young, so we plan accordingly, only to find ourselves later with a family and home that the plan didn't anticipate. When planning your investment strategy, it's important to acknowledge that change is inevitable. What matters to you today may no longer be important in the future. The best approach is to aim for a balanced lifestyle throughout your working years, moderate savings, manageable work-life balance, reasonable commute times, and time with family. This approach increases the likelihood of sticking to your plan and minimizing regret as opposed to focusing too much on any one extreme. Chapter 15. Nothing's free. Be willing to pay the price for success. Everything has a price, but not all prices appear on labels. Successful investing comes at a cost. However, the price isn't always measured in dollars and cents. Instead, it often involves volatility, fear, doubt, uncertainty, and regret, costs that are easy to overlook until you're facing them in real time. Few investors are prepared to handle the discomfort of losing 20% of their investments. If you're investing for the long term, you must be willing to accept the short-term price of market fluctuations. Think of market volatility as a fee, not a fine. For example, a Disneyland ticket may cost $100, but it provides an unforgettable experience in return, and many people are willing to pay that fee. The key is to see market volatility in the same light as a necessary fee for long-term returns. If you can view it as such, you're more likely to endure the inevitable ups and downs, staying in the game long enough for compounding to work in your favor. Chapter 16. You and me. Find your personal financial identity and play your own game. Beware taking financial cues from people playing a different game than you are. The author advises us to take the time to clearly identify our financial strategy. Are you a long-term investor, optimistic about the world's ability to generate real economic growth over the next 30 years, allowing your investments to benefit from that growth? A short-term investor and concerned with the long-term price of stocks, as long as they show momentum and can increase in the short term. It's crucial to understand your own time horizon and not let the actions of others influence your decisions. Investors with different goals and time horizons may interpret stock prices very differently. For instance, a stock that seems overpriced to one investor might be a great buy for another. When a CNBC commentator advises buying a stock, they don't know your unique circumstances. Are you a teenager trading for fun? An elderly widow on a fixed income? Or a hedge fund manager trying to meet short-term targets? The priorities of these three investors are vastly different, so what works for one doesn't necessarily work for another. Chapter 17. The seduction of pessimism. There is cause for optimism in the long run. Optimism sounds like a sales pitch. Pessimism sounds like someone trying to help you. Develop an investment plan that suits you and stick to it, especially when the market experiences declines. Avoid making changes or withdrawing investments during downturns, as this is key to long-term success. The media often uses fear to drive investors into making irrational decisions, and it works because pessimistic narratives are easier to craft. They tend to be more recent, making them feel more urgent and immediate. Optimistic stories, on the other hand, require looking at long-term history, which people often overlook and find harder to piece together. For example, a 40% drop in the stock market over 6 months may lead to significant media attention and political investigations, but a 140% increase over 6 years often goes unnoticed. The short-term sting of pessimism grabs attention, while the long-term pull of optimism is often ignored. The key to handling uncertainty is staying calm and accepting that market volatility is inevitable. True financial optimism is expecting setbacks and being pleasantly surprised when things go better than expected. It's a belief that, over time, the odds of a positive outcome are in your favor, even though challenges along the way are unavoidable. Chapter 18. When you'll believe anything, stories trump statistics. Appealing fictions and why stories are more powerful than statistics. The more we desire something to be true, the more likely we are to believe a story that exaggerates the probability of it happening. For example, after World War I ended, many believed that another world war was impossible. Yet, just 21 years later, World War II began, claiming 75 million lives. Housel argues that there are many beliefs we hold simply because we want them to be true. He calls these appealing fictions, and they significantly influence our perceptions, especially in areas like investments and the economy. Chapter 19. Altogether now, how can you change your behavior to become financially successful? This chapter summarizes the key lessons from the previous chapters. Find humility and compassion. When things go well, practice humility, and when things go wrong, embrace forgiveness and compassion. It's never as good or as bad as it seems. Less ego, more wealth. Wealth is built by sacrificing immediate pleasures for future options and growth. No matter how much you earn, you must control your spending to build wealth. Manage money for peace of mind. The best guide for financial decisions is to ensure your choices allow you to sleep at night. Increase your time horizon. The most effective thing you can do as an investor is to extend your time horizon. Time magnifies small gains and diminishes large mistakes. Embrace failure. Expect things to go wrong. Success doesn't require everything to work. Small wins often produce the most significant results. Evaluate your success by looking at the entire portfolio rather than individual outcomes. Use money for freedom. The ultimate financial reward is control over your time. The ability to do what you want, with whom you want, whenever you want, is priceless. Be kind, not flashy. People are less impressed by your possessions than you think. Kindness and humility garner respect more than material wealth. Save without a specific goal. Saving without earmarking funds for something specific is a powerful hedge against life's uncertainties. Understand the cost of success. Everything worthwhile costs something. The cost of volatility, doubt, and regret are part of the game. View them as fees rather than fines. Allow room for error. Leave enough margin for unexpected events, which gives you endurance and lets compounding work its magic. Avoid extreme decisions. Financial goals change over time. Avoid making extreme decisions that might lead to regret as you evolve. Embrace calculated risk. While you should be comfortable with risk, be wary of risks that could lead to ruin and prevent future opportunities. Define your game. Know your financial goals and ensure your decisions align with your own objectives, not those of others playing different games. Respect the mess. Financial decisions are complex and subjective. Smart people can disagree because goals and preferences vary. There's no single right answer, only the one that works for you. Chapter 20. Confessions. The author's financial beliefs and behaviors. In this chapter, the author shares his personal financial beliefs and behaviors. Discrepancy between advice and actions. Many U.S. mutual fund managers don't invest their own money in their funds, which shows a gap between what people advise and what they do themselves. This highlights that financial decisions are subjective and there's no one-size-fits-all approach. What works for one person may not work for another. Financial independence. The author's personal financial goal is independence. To him, independence doesn't mean stopping work, but choosing work that he enjoys, with people he likes on his terms, without the need to rely on a paycheck. Achieving independence comes down to managing expectations and living below your means, with the savings rate being key. Beyond a certain income, the ability to keep lifestyle expectations in check is crucial. Homeownership decision. The author owns his house outright, despite the low mortgage interest rates at the time. He views it as the best decision from a happiness perspective, even though financially it wasn't the optimal choice. For him, the peace of mind from not having a mortgage is worth more than the potential financial benefit of investing that money elsewhere. Cash reserves. The author keeps a higher cash reserve than most financial advisors would recommend, around 20% of his assets, excluding his home. This provides him with a buffer in case of unplanned expenses, reducing the need to sell stocks during a downturn. His low risk tolerance drives this decision, allowing him to let his investments compound without interruptions. Investing strategy. The author believes that every investor should choose a strategy that aligns with their goals. He recommends dollar cost averaging into low-cost index funds, allowing money to compound over time. For his own investments, he automatically invests from each paycheck into a mix of US and international index funds. There's no specific goal, he invests whatever is left after spending. He also maxes out retirement accounts and contributes to his kids' 529 college savings plans. Net worth composition. The author's net worth consists mainly of his house, a checking account, and Vanguard index funds. His investment strategy focuses on a high savings rate, patience, and confidence in the long-term growth of the global economy. He doesn't rely on sector picking or timing the market, but rather trusts the process of long-term investment and compounding.